Chapter 13, the mortgage market. Like other markets, the mortgage market is tied irrevocably to the law of supply and demand. At any given time, a number of businesses or institutions are renting mortgage money to other businesses or individuals. The rent paid for this money is called interest. When the supply of money exceeds the demand, it creates an easy money market. When the interest charged for the money loaned during an easy money market is less than in a tight money market. The demand for mortgage money is increased or decreased by the following 6 major influences. Changes in the number and size of households, shift in geographic preference for households, existing inventory of structures, change in employment rates and income, change in costs of real property, services, taxes, and maintenance, changes in construction costs. Federal Reserve System, commonly called the Fed, is the central bank of the United States. It was founded by Congress to provide with a safer and more stable monetary system. Fed Reserve duties include conducting the nation's monetary policy, supervising and regulating banking institutions and protecting the credit rights of consumers, and maintaining the stability of the financial system. The Fed uses 3 economic tools or methods of monetary policy listed below in the order most often used. Open market operations. Open market operations involve the purchase and sale of U.S. Treasury and federal agency securities. The purchase of these securities results in an increase or decrease in money in circulation. Discount rate. The second most commonly used method of controlling the supply of money is changing the discount rate. The discount rate is the interest rate charged members banks for borrowing money from the Fed. Reserve requirements. The reserve requirements are the amount of funds that an institution must hold in reserve against deposit liabilities. Federal Home Loan Banking System was created to provide the same regulatory and administrative services to the nation savings associations that the FRS provides for commercial banks. The Financial Institution Reform, Recovery, and Enforcement Act of 1989, FARIA, created the Office of Thrift Supervision, OTS, to charter and regulate member federal savings associations. Federal Deposit Insurance Corporation. The FDIC insures deposits in banks and saving associations. Savings checks and other deposit accounts are generally insured to $100,000 per depositor in each bank or thrift of FDIC insured. Has recently been changed to $250,000. The primary mortgage market is made up of primary lenders that originate new mortgage loans for borrowers. A primary market is the market where securities or goods are actually created. The role of a mortgage broker is limited to acting as an agent. Mortgage brokers do not have the authority to approve or reject a loan on behalf of the lender. The role of a mortgage banker, on the other hand, is more extensive. Mortgage bankers, mortgage companies originate loans with either their own funds or with money borrowed from financial institutions. Intermediation is a process practiced by financial institutions to serve as intermediaries between depositors and borrowers. Disintermediation occurs when funds are withdrawn from intermediated financial institutions such as banks and savings associations. Commercial banks are primary reservoirs for commercial credit in the country and the largest group of financial institutions in both assets and numbers. Savings associations, called savings and loans associations, evolved from early building societies in Europe. In 1831, the first building society in the United States was formed in Pennsylvania. Mutual Savings Bank was organized in 1816, some 15 years before the S&L was formed. Mutual savings banks are state chartered and are similar to savings associations. Mortgage companies. Since 1980, the volume of loan origination has shifted from savings associations to mortgage companies who originate loans with their own funds or borrow capital. Only service and hold loans for 4 months. Life insurance companies, LICs, are regulated by laws of the states in which they operate. Second mortgage market. The secondary mortgage market is an investor market that buys and sells existing mortgages. Fannie Mae. In 1968, Fannie Mae became a private stockholder-owned, government-regulated corporation. Freddie Mac in 1970 was made a private stockholder company in 1989. It was created in 1970, made a stockholder company in 1989. Ginnie Mae is a government-owned and financed operation like the previous two, but they are still government-owned and operated today. Ginnie Mae is part of the Department of Housing and Urban Development, HUD. The mortgage and MBSs are mostly FHA and VA mortgages, and some mortgages originated through the Rural Housing Service. Ginnie Mae guarantees allows mortgage lenders to obtain a better price for their mortgage loans in the secondary market. Mortgage discounting. Years ago, a system of discounting was created to make FHA and VA mortgage loans competitive with conventional mortgage loans. Discount points are based on the loan amount, not on the selling price. When calculated, the actual cost in dollars added by the discount points, each point is equal to 1% of the loan amount. Lenders use computers or prepared tables to determine the number of discount points that must be paid. However, as a general rule of thumb, each discount point paid to the lender will increase the lender's yield return by approximately 1/8 of 1%. Other sources of income lenders. In addition to discount points charged for making a loan, lenders frequently levy other charges. Loan origination fee. The fee typically includes 1% to 2% commission plus the total of all expenses. That is the end of Chapter 13, the mortgage market.